But if we are right, and of course we could be wrong, but if we're right, truly disruptive innovation is going to move into a growth trajectory that we believe will make what has happened recently to their stocks look like a blip in hindsight, given the great strides ahead. Okay, so now let's flip to the market. Year to date, the only thing that's worked is energy, up 65%. Ironically, there are two reasons. ESG, capital spending, shut down by a lot of companies in favor of dividends and share repurchases. I think that's going to change dramatically with the midterm elections. I think the spigots are going to be open and that production is going to boom to new highs here in the United States. And then the other two top performers, utilities and staples, both down 7 to 8%. And then on the negative side, we have year to date, comm services. Of course, the Meta was the poster child this year, down 44%. Consumer discretionary down 35%, tech down 32%. In the bond market, we're getting some indicators. We now have the yield curve down more than 50 basis points. And here's another case in point where I think people are saying, oh, but the base was so low, going up from 0.25% to 4% in the Fed funds rate. It's not a big deal. It is a big deal. In economics, activity is determined at the margin. You take a price up that dramatically, or a cost up that dramatically, 16-fold, there are going to be serious ramifications, and we think they're upon us. And advertising is the first category that businesses cut, and it's being demolished. So the markets are speaking quite loudly here. That 53 basis points on a 4% interest rates is a lot different from 50 basis points on 15%, which is what we saw in the early 80s, which is the last time we saw an inverted yield curve, this inverted. I think what's throwing people are spreads. So spreads, the difference between high yield bond yields and the treasury yields, they're up, they're moving up, but they're not skyrocketing. And I think a big part of that is energy bonds, and energy is a big user of debt because prices are still pretty elevated, and these companies are making tons of money. That their spreads are very narrow, and they're holding the broad-based aggregates down. So we think if you look beyond, or if you look at spreads beyond energy, you'll see some pretty significant gapping out, and that's a sign that there's some duress out there. Another indicator is credit default swaps. And I've been watching these, especially as they relate to money center banks. We know when it comes abroad to the banks, Credit Suisse, for example, blowing out to all-time highs. But Europe has very significant problems that we may not. The credit default swaps of our banks, so I keep track of Bank of America, Goldman Sachs, JP Morgan, and others, they've been gapping out. What's going on there? And I think what might be going on is uncertainty or concern about swaps, a little bit like what the LDI problem that the UK was forced to address. So very interested in that. I always ask our analysts to listen for questions about spreads on earnings calls, and they're not getting a lot of questions. So maybe we'll have to make some of our own phone calls there, even though we don't own any of these banks. And the other thing I'd like to say about markets is, and many people don't have this perspective, but we remember 08-09 because people were losing their homes, and it was tragic. But if you looked at stocks and bonds in the 08-09 period, what we saw was, in terms of wealth destruction, using both stocks and bonds, 21%. 7.5%. 7.5% back then, because bonds held up. This time around, bonds have not held up. We've had the worst bond markets since I've mentioned this before, you have to go back into the 1700s to see year-to-date performance worse than this. And what we're experiencing, if you combine equities and bonds, is a 21% decline in wealth, real wealth destruction. And if you look at some of the surveys, University of Michigan's survey, and you separate high-income earners from low-income earners, high-income earners' sentiment is lower than the low-income earners, even though the food and energy price hits have been much more severe when it comes to the low income. Other markets, commodity prices I just gave you, is there any place to hide? I mentioned swaps being something we have in mind here. They may have worked very well for Blackstone's REIT product, but when I see swaps being used so significantly, I just want to learn more, shall I say. Now, the interesting thing about this environment is if you look at crypto. So Bitcoin has been incredibly stable since its June lows. In fact, the volatility, 30-day volatility of Bitcoin has dropped below the 30-day volatility of the S&P and the NASDAQ. And you'll see that in our Bitcoin Monthly. We're publishing it this evening. And there are some very provocative charts in there that are suggesting we're in a bottoming period for Bitcoin. Now, we do have to be careful. We've seen a nice base develop here. And as many of you might remember from our Tesla call in the day, I said, the base, whenever you have a very long base, and in the case of Tesla, it was 5 years, but whenever you have a very long base, something big is going to happen, because that's the bull and the bears dueling each other. In the case of Tesla, our bet was we break out, and we did. In the case of Bitcoin, we would expect the same. The base is not nearly as long, and a lot of the on-chain analytics are supporting that point of view. We're also going to be talking more about this in our market update next Tuesday. And in the next few weeks, you'll see 3 research papers, one on AI accelerators, one on the Bitcoin energy / utility ecosystem, pretty provocative, and one on how important, maybe the most important innovation in history will be autonomous mobility. With that, I'll leave you with this idea that, once again, that Bitcoin is an example of a very early stage innovation that we think has miles to go. And so this down round is in the early stages of early stage growth. The volatility is normal. But then again, when you look back historically, that volatility, which feels so awful at the time, turns into, looks like a blip if you look backwards. And we think that's a case with truly disruptive innovation around which we have revolved our strategies, as opposed to the FANGs, which are being disrupted. That's a completely different story, completely different. Now, we may share some of the cyclical fallout from advertising, but that's it. And I think we're going to separate the wheat from the chaff here in terms of truly disruptive innovation versus those being disrupted. So stay tuned, and we will look forward to sharing our insights with you over the next month, and I will be back next month.